In this loan interest repaid annually column, that's simple interest, but you're earning compounded interest in the form of the dividend in the net cash value, right? So what happens is as you are continuing to add to the premium and as you're paying back that loan, right? Because what we're doing is we're going to be paying back the loan every single year in the form of $6,000, because you could see here we took a loan of 30. -6 means we're paying six back, we're paying six back, we're paying six back. And this is the interest expense, this is the loan balance. And as we pay it back, these numbers jump back up, right? Because the loan has been paid back, we have more collateral capacity, and we go from there. So you can see at the end of year 8, we put in $90,000, but we paid back the loan, right? Hey, what's going on, cash flow hackers? Behind me, I have an illustration showing exactly how whole life insurance policy loans work, how you can leverage them to increase the efficiency in your financial life and create more security, guarantees, opportunity, and control in your life simply by having more control of your money, stop transferring your wealth away to the banks, recontrol and create your own banking infrastructure. And you know what? This video I'm doing in response because last week I did a video talking about how policy loans work. And I wanted to keep it simple because it can get a little complicated. But to that end, I created a Google Sheet. And in that Google Sheet, what I did was I tried to break down and only focus on the simplest parts just to get the principle across to people to understand. So I got some negative feedback, if I'm being real, and people wanted to get into it. So what I did is I had one of my agents go through, put together this illustration, show how to use your whole life policy to buy a car every 5 years throughout your life. So what we're doing here is I'm just going to take and focus on one car. We can take this example and scale it up for real estate. We can take it and do a lot of different things, right? And what this is all about is showing how you can create wealth inside of your life without taking as much risk. Remember, the average American, the average North American, I think, has under $200,000 saved when they hit retirement. What you're gonna see in this is by saving money, just by saving money, operating more efficiently, you can get to where you wanna go with more guarantees, more predictable results, and it ultimately puts you as the only variable in your financial success. So here we go, let's get into this. So the first thing I wanna do is I wanna take a high level view to show you kind of the functionality. You can see, and I wanna talk about how we're funding this policy. So what we've done is we've taken a 26-year-old because we wanted to show what happens if you start young, what happens if you implement this starting at a young age, because it can show you, let's say 6 or so car buying cycles, right? If you buy a new car every 5 years or so, remember, the principles that we talk about here are the overriding principles. You kind of are in one of two camps typically when it comes to buying a car. You either believe that you should pay cash for a car to avoid paying interest expense, or you believe that you are going to finance your car. Or even if you don't believe you're going to finance your car, or that financing your car is the best way, that's what you do because maybe you haven't saved enough. We talk about this concept about a debtor, somebody who pays for their car and then is always trying to get back to zero. A saver, somebody who saves for their car and then pays cash for it and gets back to zero and then has to resave and gets back to zero. Or we talk about what we call wealth creator. And now this, what I'm about to show you, is how you become a wealth creator and create wealth without taking as much risk. Remember, my mindset here is if I can show you a way that you can get small returns and increase efficiency in your life on the majority of the money that flows through your life, then we don't have to worry about taking a small percentage and chasing big returns with huge risk, uncertainty, higher chance of failure, ultimately landing you in the bulk of Americans and North Americans where 95% of people are not getting to where they want to get when it comes to their money, right? So this is a big thing. So here we go. 26-year-old, $20,000 dump, first year premium. So that's a $10,000 dump in. Let's just assume they had $10,000 in a savings account and they're going to pay $10,000 a year for a premium. Look at this not as an investment. I want to be really, really clear on this. Not as an investment, but a forced savings plan, right? So think about that. What they've done here is they have $20,000 going in the first year, like I said, and we have you can see you got $16,514 in liquid in net cash value. You got about 90% of that value that's available. You got a $1,530 annual dividend that gets paid year one, right? So that's pretty awesome. You can see here we have $10,000 a year premiums going in. It takes 3 years to capitalize this, right? You're saving up. Remember, we're thinking about in terms of buying a car. And like I said, we could scale this up for any kind of investment. It works best with cash flow real estate, quite frankly, because it's an appreciating asset. You can use the cash flow from the real estate to pay back the loans. And I'll do another video on that. I think that'll be really helpful for people. But in this scenario, you could see by the end of year 3, we've put in $20,000, $30,000, $40,000, right? We have net accessibility to $34,749, but because we took a $30,000 loan, our net gain is negative $20,608 because part of that is being collateralized. And what I'm going to do is I'm going to go down and I'm going to show a loan report here in a second. So at the end of this, we call this your collateral capacity, the net cash value. That's how much you have available to you based on the moving parts and what you've done inside of the loan. You borrowed against it, and now you're showing that you only have a collateral capacity. You could only borrow 90% effectively of that $4,700 left. So now what we're doing is we're taking a look at the loans and withdrawals report. Now, I'm going to go back to this and start back at the top here and talk about the fact that we got $20,000 going in year 1, $10,000 a year after that. But over here, what we have is a completely different set of columns that focuses on everything that we have going on, right? So we have a loan amount less the dividend to pay the loan, right? So in this scenario, what we're going to do is when we take a loan, we're going to pay back we're going to pay back principal and interest. We're going to leverage the dividend to help us accomplish that. And then the loan interest to be repaid annually. So it shows that when we take a $30,000 loan, we do pick up an interest expense, obviously, right? When we pick up a loan balance, you can see here we pay $6,000 a year because we're getting back to good. We paid we got a $30,000, $24,000, $18,000, and so on and so forth. Because this is simple interest, it makes it really easy, really clean, and we go from there. Now, you could see here that the net premium outlay, we got negative $18,500 this year that we took the loan out because we got $30,000 plus we're assuming that we did that and we have $1,500 loan interest that's paid. So $31,500. We have the $10,000 premium. So 31, when you do 30,000 minus 11,500, which is a 10,000 plus this loan interest repayment amount, it's a net premium outlay of negative 18,500, right? So this is where I was trying to simplify things in the calculator in the video that I did last week, right? Is to kind of not have to get lost in all this minutia. But I think it's important to really understand it, and people came back at me saying they wanted it, so here we are, we're going through it. Now, when you look at this, you could see the death benefit is going up, so on and so forth, but the death benefit did go down here. Why did the death benefit go down here? The death benefit went down here because of the fact that we have a loan against it. So what it's saying is, this is the net death benefit after all the loans are repaid. Because remember, you are never borrowing money from your policy, you're borrowing money against your policy. And when you borrow money against your policy, you are using the cash value inside your policy that's always growing at a higher rate, right? And so you're earning the dividend on everything that you have in the policy. That's it. Yes, you have an interest expense, but they're two separate columns. So when you're paying simple interest, this is how this works so powerfully. You're paying simple interest right here in this loan interest repaid annually column. That's simple interest, but you're earning compounded interest in the form of the dividend in the net cash value, right? So what happens is as you are continuing to add to the premium and as you're paying back that loan, right? Because what we're doing is we're going to be paying back the loan every single year in the form of $6,000, because you could see here we took a loan of 30, negative 6 means we're paying 6 back, we're paying 6 back, we're paying 6 back, and this is the interest expense, this is the loan balance, and as we pay it back, these numbers jump back up, right? Because the loan has been paid back, we have more collateral capacity, and we go from there. So you can see at the end of year 8, we put in $90,000, but we paid back the loan, right? We've saved and we have more money than we've actually contributed to the policy at the same time. So now what do? We take another car loan for $30,000 because listen, this one broke it, we put a couple 100,000 miles on it maybe if you travel as much as I do and drive as much as I do from Arizona to Vermont. to visit family, whatever, and I'm just crazy. I like to travel like that. I like to drive. We do a lot of driving with the Jeep in the mountains. Arizona's a big state. And so we go $30,000 for the car there, and you can see we just repeat this process of $6,000 repayments. It goes the whole way, but the thing is every time we pay this back, the cash value just keeps growing and growing and growing and growing, and we're doing this all on a fixed basis, right? So you can see here, this is why I did the calculator the other day, is because when you look at the numbers here, it gets really confusing, because what you're doing is you're just showing, well, what this is doing is it's showing a combination of the premiums that are being recontributed, right, that you're contributing every year. It's combining the loan repayment, and this is accumulation of everything. What I did with the other spreadsheet that I did last week, and if you want to go check it out, just look up on the channel how policy loans work. I'll leave a link in the description below so you can check that out after this video. I try to just say, okay, this is all gets really confusing when you look at it over and over and over again. I'm really just showing this to show that it does work like I'm saying it works, right? Like, so you can understand that over time, this is actually how it works. But what I did in that video is I said, okay, let's just take this section right here and repeat that process, right? That's really what I did, is I said, okay, let's go down to here. Actually, it was probably not that year because it's not gonna be as good early in the policy. It's still good, but you're paying to be, the more mature this gets, the better off it is. So in this scenario, if you just stay consistent in this, it gets better and better and better. So like in the calculator that I showed, like it's focusing on like a 5 or 6 year window, right? Like that 5-year window where you bought the car, you paid it back, talking about the efficiency. Yeah, you picked up the interest, the loan cost that comes, so there's a cost of that money to borrow it. That's this interest expense. But this compounds and grows at a much faster rate than you are contributing. So the way that I would do this here is just to show you a point, right? So in this scenario, and I got to run some numbers here. And so in this scenario, what you have, and I'm going to highlight this again just so I can get through this with you here, just to show a point. So in this scenario, you had, I'm going to add up the interest expense here, 1,500, 1,200. That's 27 plus 9 is 36, plus 6 is 42, plus 300 is 4,500. So you picked up 4,500 in interest expense over that period of time, right? So, but here's the deal. You had that point in time, you started that period with 166,000, right? 166,000, and at the end of that period, you had 293,000, right? So think about it. 293, listen, I mean, this is super powerful, guys. I'm just gonna do super simple numbers and keep it round. 293 minus 190,000, right, is easy. That's $103,000. But don't forget, you paid the premium. So you got 1, 2, 3, 4, 5 years of premium. So we're gonna minus the 50,000 in premium that you paid, right? And then we're gonna minus out the $30,000 for the car, right? And you got $23,000 pretty much of extra money. Now remember, I was keeping those numbers super round, but in that effect, because, and don't forget, this is when the policy is more mature, but you're in a much better situation. You are creating wealth simply by taking advantage of paying simple interest, earning compound interest, and putting yourself in a position to win with no extra risk, right? That's just financial efficiency. So think about this. With $10,000 here, remember, you don't have to contribute for this long. You know, like, I mean, you can see here, why would you ever stop if you're saving $10,000 and your policy's growing by 16,000, right? Like, why would you ever stop that? But now I'm gonna go back up to the actual policy up here, right? And kind of talk to you about, like, look at the annual dividend. I want to get to this, and I want to show you like how powerful this is right here, right? So when you look at this, let's say you get to age 65, or no, let's just go all the way, because we did loans all the way through 66, right? That was the last loan I think we got. So you can see here that you have net cash value of $1 million doing this, right? You have a death benefit of 1.461 million, but the annual dividend is 27,598. Now that's not crazy amazing, but what that is it's income, right? This is a situation where you can leverage that money for income. You can leverage it for whatever you want. You can use this policy as a volatility buffer. All this does, this is a savings account on steroids. If you were, like, if I were in this position where I had this kind of capital, I would never let this amount of money, by the way, sit in my policy. If you have a whole life policy and you have this much money sitting in the policy, you're doing something horribly wrong, in my opinion. I mean, I guess if you want it there because you're a higher income earner and you want it as an income volatility buffer, then you know what, it can make a lot of sense. But for most people, you want to get that money in motion. You want to get it moving. You want to be doing what I showed down below and borrow it and leverage it for illustrations, right? Or leverage it, I'm looking at the illustration. Leverage it to be able to earn interest on it. So when we look up here, what we're talking about is, let's just say at 40, we got $160,000. So remember, we've saved all this money. We're buying cars through this policy, but we still have a net cash value, let's say here, of $179,000 of $200,000. At this point in time, I could use that money as down payments for multiple houses, for multiple cash flow properties. And now not only am I financing my cars in my own banking system, I'm now putting real estate through it as well. And that's where cash flow hacking is coming into the conversation, right? Is funding a whole life policy, getting it into real estate, and doing loans through that. Now, the other thing that I did in the last video was I showed how the cost of money inside of a policy loan with a whole life insurance company is more expensive, right? So that cost of money is obviously real. Now, what you can also do, which is better in my opinion, I know a lot of pure infinite banking practitioners don't like this because they say, why are you going to try to create your own banking system just to bring banks back into the equation? But I'm a big believer that if we can reduce the cost of money, that just makes sense. And so what I believe is that we should be taking the value in this policy, doing what we call a cash value line of credit, assigning the policy and guaranteeing the line of credit with a bank with the policy, and they're going to give you cheaper money. Instead of paying, say, 5% interest on the loan, you're going to pay, say, anywhere between 2 and 3% interest on the loan right now. So when you look at that option, now all of a sudden your cost of money goes down, and from a cash flow perspective, you're going to be putting money into that car anyway. You're going to be paying for that car no matter what. So you might as well pay for that car through the cheapest form of money that you can get. In fact, I would say don't even use it at all. If the bank is going to give you 0% interest or 1.5% interest or 0.99% interest or something of that nature in a promotional rate, you can leverage that. But here's the one thing I'll warn you about utilizing dealership financing. They get you one way or another typically. So even if they say we're going to give you low interest, they're pretty much usually going to raise the cost of the car. So make sure that you understand what the real net costs are. Having access to capital in a policy like this can be super leveraging for you when it comes to even buying your car. I mean, when I talk a lot about the trailer that I bought, the camping trailer that I pulled behind my Jeep, I went out, and because I had access to this, it's a $30,000 trailer MSRP. They were trying to give me a great financing rate at $26,000, and if I were any normal person, they would be getting me to believe that, oh my gosh, they're giving me $4,000 off plus this great APR. It's fantastic. But because I came in with this and I had leverage and I was able to do it the way that I'm teaching you, they gave me that trailer for $19,900. Okay. So I basically got 33% off the trailer because I had leverage. The person with the gold makes the rules. That's what Nelson Nash said, right? That is the golden rule. The person with the gold holds makes the rules, right? And so that is something to understand. And when you have these policies and when you leverage it this way, you are the one who ends up making the rules. At the very beginning of it, I will agree with you. There is a period of time that takes to capitalize a system, but you have to have a long-term view. And when you do that the right way, and when you execute the right way, and you fund it the right way, and you stay disciplined, remember, this is not an investment because investments have risk. This has no risk. If you just fund this, like this is, we're at the lowest dividend rate. This illustration is focused on the lowest current dividend scale that we've ever had in the history of the 120 years of the company that I'm showing you right here, right? So that all said, I believe that long term, the real results will actually outperform this. Now, that's just my opinion. I can't guarantee that. It's a bit conjecture, I suppose, but that's what I believe. So that's why I love this so much. If you have any questions, leave them in the comment section below. If there's something you liked in this, let me know. If there's something you didn't like or had a question about, let me know. I'm happy to get into it with you. Hopefully you found value in this, because I'm telling you, if you can understand this, it will make a huge impact in your life. So if you did find value, please smash that like button. If you haven't already, hit the subscribe, click the bell, that way you get notified every time I launch a new video. And until next video, go out, have a blessed and inspirational day, and we'll talk soon. See ya.